What if I told you that everything you've been taught about debt is wrong? Yes, debt. The word that most people fear, but the wealthy embrace. Here's the truth. Debt isn't just something to avoid. It's a secret weapon, but only if you know how to use it. In today's video, we're diving into the 7 most powerful ways rich people turn debt into a money-making machine. Plus a bonus tip at the end that personally helped me a lot. And we'll be guided by none other than Robert Kiyosaki, the legendary author of Rich Dad, Poor Dad. Stick with us, because by the end, you'll see debt in a whole new light. Let's be real. Most of us have been taught to fear debt. We hear things like, stay out of debt or it'll ruin your life. But what if I told you that the wealthy think differently? Robert Kiyosaki flips the script on debt. He says there are 2 types, good debt and bad debt. Bad debt? That's when you borrow to buy things that lose value, like cars or clothes. Good debt? That's when you borrow to buy assets that make you money. As Kiyosaki puts it, bad debt is debt you have to pay for. Good debt is debt that pays for itself. So, how do the wealthy use good debt to build empires? And here's the best part. You can do it too. Let's break it down. Number 1, using debt to invest in real estate. This is Kiyosaki's bread and butter. He's made millions by using debt to buy real estate that generates income. His mantra? Your house is not an asset. An asset puts money in your pocket. Here's how it works. You find a property in a good neighborhood. Let's say it costs $200,000. You take out a mortgage and rent the property to tenants. If the rent is $1,500 a month and your mortgage is $1,200, you just created $300 of monthly profit. Plus, as the property's value goes up over the years, you build even more wealth through equity. Simple, right? Kiyosaki explains, real estate is one of the safest ways to build wealth because it generates consistent cash flow. So, why not let someone else's rent checks pay off your debt while you build wealth? Number 2, refinancing properties to reinvest. Here's a pro move. Refinancing. Kiyosaki teaches that you can refinance a property to unlock its equity without selling it. That cash can then be used to buy more assets. Imagine this. You own a property worth $500,000, and you've paid down $200,000 of it. By refinancing, you can pull out that $200,000 and use it to buy another property or start a business. The rich use debt to make more money. The poor use debt to buy things that make them poorer, says Kiyosaki. This is how the rich create a snowball effect, turning one investment into many. Number 3, leveraging lines of credit for small businesses. Kiyosaki is a huge advocate for entrepreneurship. A business owner uses other people's money to expand their enterprise and create wealth. He says, let's say you're a carpenter with a small business. You take out a loan to buy better tools and equipment, which allows you to complete jobs faster and take on more clients. And here's a backup plan. If business slows down, you can rent out those tools to others and still generate income. This is how you turn borrowed money into a profit machine. Number 4, acquiring productive assets with financing. Kiyosaki teaches that debt should only be used to buy assets, not liabilities. Rich people acquire assets. The poor and the middle class acquire liabilities that they think are assets. A practical example? A small manufacturing company finances a new machine that increases production. The additional profits pay off the loan and boost the company's bottom line. This is how the rich make debt work for them. Number 5, consolidating debt to reduce costs. Even if you've made some mistakes with debt, Kiyosaki's principles can help you recover. Consolidating high-interest debt into a single loan with a lower rate frees up cash flow. That extra money can then be invested. For instance, let's say you have $20,000 in credit card debt at 20% interest, which costs you $4,000 a year in interest alone. By consolidating it into a loan at 8%, your interest drops to just $1,600 a year, saving you $2,400 annually. Instead of watching your money disappear into interest payments, you can invest those savings into something like a high-yield savings account or an index fund. An index fund is a simple way to invest in every stock within an index in proportion to the size of each company. For example, a fictional USA 10 index fund might include the 10 largest US companies, such as Apple, Microsoft, and Google, distributing investments based on each company's size. This way, you're not just reducing debt, You're using your savings to build wealth. Number 6. Using leverage in the stock market. Leverage can amplify gains, but it's not for the faint of heart. Kiyosaki warns, the key to using leverage is education. Without it, leverage is risky. For example, you might use margin to invest in dividend-paying stocks. Imagine you borrow $10,000 at a 5% annual interest rate and invest it in a portfolio yielding 7% in dividends. The dividends not only cover the $500 interest cost, but also leave you with an additional $200 in income. Over time, as the value of the stocks grows, your profits multiply. However, it's crucial to understand the risks involved. A market downturn could affect both your dividends and stock value. Number 7. Leasing instead of buying. Kiyosaki's principles align perfectly with leasing. Why tie up capital in depreciating assets when you can use it to invest? For example, instead of spending $30,000 on a car, you lease one for $400 a month. This means you're not tying up a large amount of capital in a depreciating asset. Instead, you can take the $30,000 you would have spent and invest it in an asset that grows in value, like a high-yield savings account, stocks, or even a small business venture like a small online store that sells products for iguanas. Over time, this strategy can generate returns far greater than the cost of leasing. It's about making your money work smarter, not harder. Bonus tip: investing in renewable energy. Although not a central theme in Kiyosaki's teachings, the principles still apply. Financing renewable energy systems, like solar panels, can reduce costs and increase property value. Let me share my own experience. A few years ago, I decided to install solar panels on my house. I took out a loan to cover the $20,000 cost, which seemed like a big commitment at first. My monthly loan payments were about $200, but my energy bills dropped by $250. That meant I was saving $50 every month right from the start. Over time, as energy prices continued to rise, my savings grew even more. After the loan was paid off, the panels continued to provide free electricity, essentially putting extra money in my pocket every month. This experience taught me how debt, when used strategically, can truly work for you. Debt isn't the enemy. It's a tool. The wealthy use it to buy assets, grow businesses, and build empires. As Robert Kiyosaki teaches, the key is to be strategic and intentional. From real estate to renewable energy, there are countless ways to make debt work for you. Now it's your turn. What's one way you can start using debt to build wealth? Drop your thoughts in the comments below. And don't forget to like this video, subscribe to the channel, and share it with someone who needs a new perspective on money. Financial freedom starts with financial education.